Joining me now, Disruptive Tech Research founder and chief analyst Lou Bassanese. Lou, these Wall Street analysts just got it so wrong.
Wrong, dead wrong. They're useless. Yeah, so many things here, right? This is common. I mean, for viewers that don't understand this, there was 35 sell-side analysts that had a buy rating on Netflix with price targets that were astronomical. This is routine. This company telegraphed that they were going to lose subscribers in March when they said they were going to start charging for sharing passwords. I mean, that was the tell that the growth was slowing, and there's just no grace when there's no growth. And that's what we're seeing here. We're seeing the stock sell off heavily. I think it's down about 65% in the last 4 months alone, and there's probably another 20 to 30% downside if you take out user growth. You got some really scary fundamentals. You got soaring content costs, you got a high debt burden, increased competition, and worst of all, you got a consumer who's really strapped in their wallet, right? So gas prices, food prices climbing, and we all have way too many streaming services. I mean, I tried to think before we came on how many I have, and I can't even list them off. I mean, it's at least 4 or 5. It's just insane that we're paying for all this now.
Right, and Netflix raising prices for the first time since 2020 at the same time that inflation is soaring. So way to chap and chafe your existing customer base. And then it turns around and blames password sharing. Password sharing is the new bad weather, I suppose.
Yeah, well, it gets even worse, right? CEO Reed Hastings was adamant for years they would never add ads to the platform, and now guess what? They're going to have a lower cost option that has ads, which defeats the entire purpose of streaming, right? That was the appeal in the golden days of streaming coming out, is that we could stream whatever we wanted and fast forward through ads or not have to view them at all. And now, basically, in the name of profitability, they're going to start bringing back ads. Right. That is absolutely going to impact the growth. Those analyst numbers and even the company's numbers for 2 million subscriber growth dropping, I think those are going to be conservative. You got a lot more bleeding coming here, both from the stock and the business itself.
So just to put an exclamation point on this, that Netflix is going to end the first half of the year with 7.8 million fewer subscribers. So almost 8 million fewer subscribers than Wall Street was expecting. Were they not watching the garbage on Netflix? Because again, it's really hard to find anything that's worth watching for the price. I mean, you got to do the cost-benefit analysis. And I was saying earlier that Anatomy of a Scandal, which is like #1 on the service right now, is like a Lifetime movie with fancy British accents. It's terrible. And I'm sure they paid an ungodly amount of money for it.
Come on, there's such a big audience for Lifetime and Hallmark movies. But no, I get it. What has happened is we've reached streaming saturation. There is too many content choices. You saw all these platforms get into original content, Netflix outspending them all, and it's just too much to consume. I think you've hit peak streaming where the consumer really can only have, right now, the latest Nielsen data is 65% of consumers have 3 streaming services or less. What happened was a ton of people got up to 5 and 6 services and realized it's just too much content to consume. So with COVID really ending, people returning to work, we can't just sit around in Netflix and chill. And like I said, I think there's a lot more downside ahead for this stock, a lot more subscribers that are going to leave the platform because of costs and just, too much content to consume. Luke, so they're going to have to make choices.
The Netflix stock had already lost 42% of its value before what's going to happen today, where it's going to lose an additional 1/4 at least of its value in a single day's trading. What about the other streaming giants? Disney has a much bigger ocean that it swims in. Apple, it's the same story. But I look at a Warner Brothers Discovery, the newly merged entity. It's toting around $58 billion in debt. CNN Plus, a disaster in terms of misspent money. Where does Netflix story, what does it say about other streaming companies before we go?
Yeah, no, it's a great question. Yeah, great question, Dick. And I think there's going to be a hangover effect, right? You're going to see this trickle into all the other streaming services. The most vulnerable ones are going to be the newest ones, right? Because you're competing for a smaller and smaller available budget from the consumer. So CNN Plus, absolutely doomed. I think you're starting to see those headlines now. Debt burdens with rising interest rates. Any content providers and streaming platforms that have high debt are really going to be struggling because they're going to have to pay more to service that debt in the years ahead. So again, I think you're going to see a lot of consolidation in this space. We're going to go from 7 or 8 mainstream platforms to maybe 2 or 3 that really earn consumers money and their attention.
I'll report back which ones I cancel, and it's going to be a lot of them. Lou, thank you so much.
Sounds good.
Lou Bassanese, always a pleasure. We'll be right back.